Very good afternoon to all the respected dignitaries, learned speakers, and my dear professional colleagues. On behalf of Direct Tax Committee of Institute of Chartered Accountants of India, I warmly welcome you all to the second session of the live seminar web series on the Income Tax Act 2025. Today's session focus on a very important and practical subject: taxation of profits and gains of business or profession, method of accounting, set off and carry forward of losses, a topic that lies at the heart of each and every person who practice in direct tax. This webinar is being organized by Direct Tax Committee of ICAI with publication support from the Income Tax Department, Directorate of Income Tax. We sincerely acknowledge and appreciate their collaborative effect. My name is CA Ankush Kesharwani, Managing Committee of Nagpur branch of ICAI, and I will be moderating this session. First of all, I would like to thank CA Piyush Hajir ji and CA Vishnu Agrawal ji for giving me an opportunity to moderate this session. Thank you, sir. It is indeed my privilege to be part of this knowledge and enriching program. Let's have a brief introduction of the committee chairman who has joined us, CA Piyush Hajir ji. We have a Central Council member and Vice Chairman of the Direct Tax Committee along with us, CA Vishnu Agrawal ji, authorized person from the department, Shri Aniruddha sir. He is an IRS officer and currently Deputy Commissioner of Income Tax, Gurugram. I also welcome today's speaker, who is joining us from Chennai, CA Shashank Srivastavan sir. I welcome you all, sir, to today's seminar. We have a dedicated Central Council member, CA Piyush Hajir ji, who is a chairman of the Committee of Direct Tax. CA Piyush Sohan Raj Hajir is a senior chartered accountant with over 25 years of distinguished professional experience in the field of taxation, audit, and advisory. He is the senior partner at Messrs. Chachad and Doshi Chartered Accountants, Mumbai, a well-established professional firm. He is also contained a DISA. He is also DISA qualified. He is widely regarded as an expert in direct tax litigation and advisory with extensive experience in handling complex and high-value matters. C.H. Hachet sir has served as a member of Central Council of ICAI during the term 2022 till 25 and has been re-elected for the term 2025 till 2029. He is presently the chairman of the Direct Tax Committee and vice chairman of the Expert Advisory Committee of ICAI and has earlier served on all the three standing committees of the Institute: Executive, Examination, and Finance. At the international level, he has represented the profession through his association with bodies such as International Auditing and Assurance Standard Boards, South Asian Federation of Accountants, and the Asian Federation of Accountants. He also serves on the board of Reputed Corporate and has been associated with the Reserve Bank of India as a member of its External Advisory Committee. A regular speaker, author, and contributor to professional publications. We welcome Chachad sir on the board, and I request Chachad sir to please give his welcome address.
Thank you very much, Ankushji, for your introduction. The very respected Indian Revenue Service Officer, Aniruddha, who is the Deputy Commissioner from Gurgaon. My Vice Chairman, CA Vishnu Agrawal, who is looking into this whole web series of Income Tax Act and who is instrumental in conducting all such programs during the year that Direct Tax Committee has organized various physical programs, webinars, outreach programs. And now this we are doing it with the publication support from the Income Tax Department. So thank you to the Income Tax Department. Of course, Aniruddha is representing them. Thank you very much. And thank you very much, Vishnuji, for taking lead in all such initiatives. Speaker for the day, and the member of Direct Tax Committee, I would say, CA Shashank Srivatsan, and the moderator, C. Ankush. And very good evening to all the members who are listening to the second series of the seven webinars, which is going to happen on Income Tax Act 2025, which is an idea of sensitizing the members about what is in store in Income Tax Act 2025, what is an honest efforts made by the government of India in really making a law very simplified. Because I can tell you, as the chairman of Direct Tax Committee, and this is my second year, I was involved throughout, our committee was involved throughout since July 2024, when the Honorable Finance Minister announced in that budget that we would like to simplify income tax law. And I have never seen such an approach from CBDT. In September, they took this initiative, and on 13th of Feb, within 4 months, they came out with the income tax bill. I think so. I should have a loud applause for the officers who have worked day and night for in this 4 months. It's very difficult. I can tell you as a chartered accountant, if even we have to take out a publication, it takes huge lot of time. Any regulatory provisions, this is the bare law, which would be read over a period of time. And such an efforts within the 4 months of time to introduce bill on 13th of Feb 2025, which was envisaged in the first meeting in September 2024. I think so. It's a marvelous job. A loud applause I would request for everyone for this. So I appreciate the efforts of department. In fact, CBDT has been very kind. They have been very open to suggestions every point of time. Even during the initial preparation of the bill, we gave a lot of suggestions which were accepted, whereby a lot of redundant sections were removed. Similarly, after the bill was introduced, whatever suggestions we gave to select committee and which were ultimately also given to the CBDT on a clause by clause analysis of Income Tax Act 2025, 90 plus all suggestions have been accepted, do find place in the difference between the bill and the act. And therefore, I'm very pleased as a chairman of Direct Tax Committee. And I, along with my vice chairman, really thank the department for this, for such a proactive and collaborative approach, which was undertaken while making of this Income Tax Act 2025. Coming to the audience, obviously, this seminar series would be a great effort. I think so. It's a time. It's a month of December and January. This is a 2 months wherein we have joined hands with the income tax department, and we have assured them that we'll try our best, do maximum possible programs on public outreach. Sir Anirudhji, because you are listening, today I am in Jodhpur, and we have a continuing professional education committee, of which vice chairman is again a vice chairman is CA Vishnu Agarwal, who is a vice chairman of DTC committee also. And because he's busy with this webinar, I had to come to Jodhpur, and I was delivering small lecture on Income Tax Act 2025. And across India, such physical programs are happening. When we are talking to you today, there is also one outreach program happening in Kozhikode at Kerala. So institute is always with the income tax department, and whatever efforts have been done to simplify the law for the benefit of assessing, for the benefit of citizen of India, institute will always stand by to the best of us. So thank you very much once again. Most importantly, sir, Anirudhji, you will notice, and all members will notice, I am from Jodhpur today. Vishnu Agarwal ji is from Mumbai. Ankush ji is addressing from Nagpur. Shashank ji is addressing from Chennai. And you yourself are, I believe, in Gurgaon. So whole India is working on this. And the people who would be listening is not only from these cities, they are representing various branches. That is more than 175 branches which Institute have. And they are part of those branches. They may be from rural areas. You will find them. You will find the audience from each and every 700 and odd districts of India would be listening to you today and would be eager to listen to you today and the speaker Shashank. So with these opening words, I welcome you all the participants today. Be attentive. If you have any questions, if you have any suggestions on this Income Tax Act 2025, do please send it to dtc@ici.in. I can assure you, from a direct tax committee, we'll try to take up this with CBDT. And I can also assure you that CBDT has been completely open when it is comes a suggestion from Institute of Chartered Accountants of India. In fact, I was been part, myself and vice chairman were part of various committees also, which was involved into that, including revision of forms, revision of rules, which is going to happen. And I've been told that in first week of January, rules and the new forms will be coming. And we have given a great suggestions, a lot of suggestions on revision of audit reports also. So I'm sure when this come up in January, you will be able to appreciate the way the collaborative approach is going on. I hope this continues for long. Thank you very much once again. and have a nice session of 2 hours. Thank you very much, Anirudhji, for joining us. Thank you. Over to you, Ankush.
थैंक यू चेयरमैन सर। सर जैसा आपने बताया कि आईसीआई बहुत सारे आउटरीच प्रोग्राम कर रहा है इनकम टैक्स डिपार्टमेंट के साथ में। मैं आपको बताना चाहूंगा कि नागपुर ब्रांच भी इन द कमिंग वीक इज ऑर्गेनाइजिंग ए आउटरीच प्रोग्राम विद इनकम टैक्स डिपार्टमेंट। नाउ it's a time to introduce among all our very own, my very dear friend, CCM, CA Vishnu Kumar Agarwal ji. CA Vishnu Kumar Agarwal ji is a senior chartered accountant with over 2 decades of professional experience and is currently a member of Central Council of Institute of Chartered Accountants of India for the term 2025 to 29. He presently serves as the Vice Chairman of the CPE Committee and the Direct Tax Committee of ICAI, and is also associated with several key committees, including the Standing, Executive, Management, and Finance Committee. He is recognized expert in income tax and litigation with extensive experience in handling search and survey cases, Benami and black money proceedings, ITAT matters, and complex income tax litigations. His practical approach and deep understanding of the subject have made him a respected authority among professionals. A renowned speaker and author, C.A. Agarwal has addressed numerous professional forums across the country and is the author of the acclaimed book Landmark Judgments of Income Tax, which is widely referred by the tax professionals. He has also rendered valuable service to the profession as the former chairman of WIRC of ICAI and as a regional council member for 3 consecutive terms, representing the institute before various government authorities. We are indeed privileged and have to have with him us today. I request CA Vishnu Kumar Agrawal to kindly address his address the session and give his opening remarks. Vishnu
Thank
sir.
you. Thank you, Ankush Very respected Anirudh the Deputy Commissioner of Income Tax from Gurgaon, our own Chairman of the Direct Tax Committee, CA Piyush Chhajed today's learned speaker and the co-opted member of the Direct Tax Committee from Chennai, Sasank His father was also the Central Council member, and our Managing Committee member of the Nagpur branch, CA Ankush and our from my office, Priya and all my participants, ladies, seniors, and gentlemen. I welcome all of you in this second series of the webinar of the New Income Tax Act 2025. Friends, we have total 8 sessions on every Thursday from 4 to 6. For the all, we are covering all the topic with the collaboration of the Income Tax Department. First time with the joining hand of the Income Tax Department, we are doing this particular webinar on the Income Tax Bill 2025. Anirudhji, because of we are the bridge between the taxpayer and the department, so we are duty bound to doing all the outreach program and reach out with each and every chartered accountant, taxpayer, and the person who is practicing the income tax department. Sir, we have 190 branches across the country, and we are doing from each and every branch the outreach program for my chartered accountant also, as well as the citizen of the India also. And we have more than 200 study circles across the country. So almost from the across the country, we are doing the program, more than 500 program from for the this Income Tax Act 2025 for the outreaching. Because of this, my each and every chartered accountant must have knowledge of the new Income Tax Act 2025. When the GST came in the 2017, sir, we have done same exercise in the year of the 2017. And the APJ Abdul Kalam always says that the chartered accountant are in the nation building, partner in the nation building. So as a partner in the nation building, sir, we are also duty bound to help out my each and every chartered accountant also, and the handing hand with the income tax department. So none of the point we will lose. So any moment of a time when from the first April 2026, the new Income Tax Act become the effective. So my each and every chartered accountant and each and every layman of the India, they can understand the easy language of the Income Tax Act 2025. And with thanks to the department, CVDT, and the Finance Ministry to coming out with the very easy language, this Income Tax Act 2025, so anyone can understand. And I'm sure after this act, our litigation will be come down. With these words, I thanks to each one of you, and we again welcome our Anirudhji, IRS. So he will also give his opening remarks. And I request Ankushji, please read his brief profile to benefit of all the audience.
Thank you, sir. Thank you very much. Uh, we thank Income Tax Department for choosing ICAI as their outreach partner for the circulation of the new Income Tax Act, which they want to which they want to reach the each and every person. और आज के लिए बहुत अच्छी बात है कि हमारे बीच में अनिरुद्ध सर IRS ऑफिसर हम लोगों के बीच में आए हुए हैं. Friends, he is a very distinguished personality, and it's my proud privilege to introduce among you all CA Aniruddha sir. He is a 2018 batch officer of IRS Income Indian Revenue Services and anti-SC scholar. Shri Anirudh is a gold medalist in mechanical engineering from Punjab Engineering College, Chandigarh, where he graduated with a perfect 10-point CGPA and received the prestigious Institute of Engineers Kala Devi Award. He cleared the civil services examination in his very first attempt and was initially allotted the Indian Railway Personnel Service, where he earned the Director's Gold Medal at LBSNAA, Missouri, and secured second position in professional training at the National Academy of Indian Railways. Subsequently, he joined the Indian Revenue Services in 2018 and has since handled diverse and critical assignments including central charges, faceless assessment, audit exemptions, and headquarters. He is presently posted as Deputy Commissioner of Income Tax, Central Circle, Gurugram, with additional charge of DCIT headquarters in the Office of Principal Commissioner of Income Tax, Central Gurugram. In recognition of his exemplary service, he was conferred the Principal Chief Commissioner of Income Tax Certificate of Excellence 2024. He is also a regular guest faculty at NADT, contributing actively to the training of officers. I welcome you, Aniruddha sir, and I request you to please give your special address to us. Over to you, sir.
Good afternoon, everyone. Thank you so much for having me in this webinar. Today's session focuses on profits and gains of business and profession, the method of accounting, and set-off and carry forward of losses under the new Income Tax Act 2025. As you all know, this act will come into force from 1st April 2026. These provisions form the heart of business taxation. Over the years, they have also been among the most complex, disputed, and litigated parts of the income tax law. I may also briefly mention my own involvement in the exercise of drafting the new act. I had the opportunity to be a part of two subcommittees constituted for drafting the new act, one dealing with profits and gains of business or profession, and the other entrusted with the review and redrafting of sections 110 to 115 VZC. The work involved clause by clause examination of the existing provisions, identifying redundancies, obsolete references, and drafting inconsistencies. It also involved ensuring that simplification did not disturb settled legal principles or judicial interpretations. This exercise was carried out within an exceptionally tight timeline. This reflects the remarkable institutional effort and coordination within the department and with organizations such as the ICAI. This task of redrafting or simplifying the Income Tax Act has taken many years in other jurisdictions, which we have completed in a matter of months. The new act reflects a clear change in approach by the legislature. It does not change tax policy, nor does it alter the basic principles of taxing business income. Instead, it focuses on simplifying the structure and language of the law. After more than 60 years, the 1961 Act had grown from under 300 sections to more than 800, which were filled with provisos, explanations, sunset clauses, and complicated cross references. The aim of the new act is to preserve continuity in taxation while making the law shorter, clearer, and easier to understand, and without losing legal accuracy. If we look first at PGPP, the biggest improvement lies not in what is taxed, but in how the law is presented. Provisions dealing with computation of business income, allowable deductions, disallowances, depreciation, and valuation have been rearranged and consolidated. One major reform is the removal of all provisos and explanations. Instead of spreading conditions across multiple layers of text, the new act places all conditions and exceptions directly within the main provision in a logical order. This is especially helpful in business taxation, where under the old act, even a simple deduction often required referring to several provisos located far away in the statute. The depreciation provisions clearly show this approach. Coming to the method of accounting, the basic rule remains the same. Business income will continue to be computed according to the method of accounting regularly followed by the SSC, subject to the prescribed standards. It is also important to note that the assessing officer's power to reject books of accounts has not changed. A closely related reform concerns unexplained credits and investments, which commonly arise in business assessments. The earlier Section 68 has now been renamed Unexplained Credits, which was earlier Unexplained Cash Credits. This makes it clear that the provision applies not only to cash credits, but also to all types of credits, such as loans, advances, share capital, and share premium. Let me now turn to the set off and carry forward of business losses. Over time, these provisions had become cluttered with references to specific assessment years. The 2025 Act removes such outdated references. The basic principles of loss, set off, and carry forward remain unchanged. However, the drafting now fits neatly with the new concept of the tax year. By replacing the confusing dual system of previous year and assessment year with a single tax year, the law ensures that income, losses, set off, and carry forward all relate to the same time period. It is also worth highlighting that any substantive restrictions on carry forward of losses where introduced have been done through Finance Act amendments and not through the simplification exercise. I want to reinforce the idea that this 2025 Act does not amend the provisions, it is only simplifying the provisions. Any amendments will be done by the Finance Act. The new Act only simplifies and clarifies the provisions. So to conclude, this new act brings a quiet but meaningful change in how PGPP accounting methods and loss provisions are understood and applied. For businesses, professionals, and tax administrators, this marks a move away from navigating a maze of cross references towards dealing with a statute that clearly communicates what it intends to do. Thank you all for your attention. I look forward to the discussion.
Thank you, sir. Thank you, Aniruddha, sir, for your kind and insightful deliberation. We are sure the new Income Tax Act, which is going to arrive from 1st of April 2026, will be very easy, will be very simpler as compared to the current which we are facing. Thank you, sir, for your deliberation. Friends, today we have a very distinguished personality as a speaker, Sri Shashank Srivatsan from Chennai. Sri Shashank Srivatsan S is a practicing chartered accountant with over 7 years of professional experience in the areas of taxation, audit, and assurance. He completed his articleship training with Messrs. Suri and Company Chennai, a highly respected firm, which provided him with strong exposure to professional practice. Academically, he has an excellent background. He is a first class graduate in commerce from Madras University and holds an LLB honors degree. He is actively involved with the Institute of Chartered Accountants of India and is currently a member of Direct Tax Committee of ICAI. He has earlier served as a member of Accounting Standard Boards and Experts Advisory Committee of ICAI. Notably, he was also part of ICA task force representing the profession before the Ministry of Finance, the Central Board of Direct Taxes. C.S. Shashank has contributed to professional knowledge by assisting authors in the publication of books on accounting and taxation, including reputed publications such as Paduka, and is a regular speaker at ICAI CPE programs on accounting standards and other topics. His area of specialization includes accounting standards, financial reporting, index, bank audit, and direct taxation. With his strong technical knowledge, academic excellence, and practical insights, we are confident that today's session will be highly enriching. I welcome our speaker, Sri Shashank Srivastava sir, and I request Shashank sir to kindly take the session forward. Over to you, sir.
Very good evening. Thank you for the lovely introduction, Ankush sir. Thank you for being a lovely moderator. Very good evening, very warm evening. Before I start the session, I would like to thank the Chairman of Direct Tax Committee, Piyush Chajat sir, Vice Chairman of Direct Tax Committee, Vishnu Agarwal sir, and the members of the Direct Tax Committee and the Deputy Commissioner of Income Tax Central Circle, Gurugram, Anirudh sir, for spending their valuable time on a very, very, very important topic and a very, very important outreach which needs to be done on the new Income Tax Act 2025. So before I start the seminar or show any slides, I just wanted to say that the new Income Tax Act 2025 is the need of the hour for our country, because the law has taken over a period of 64 years. A lot of sections have reached sunset clauses. A lot of provisions have been repealed. A lot of provisos, explanations, and explanations for explanations, and cross references. A lot of confusion has come into the income tax law over a period of 60 years. So it was the need of the hour to bring in the new income tax law so that it becomes easier for professionals, income tax officers, and not only that, even the common man can understand the income tax law. So that was the main purpose of bringing the Income Tax Act 2025. Over my presentation today, I would show how the Income Tax Act has become simplified, easier, and very, very simple for a common man to understand. I will go through the nitty-gritties of the chapters in profits or gains in business or profession, method of accounting, as well as set off and carry forward losses. Not much change from 1961 to 2025 Act, but I will show a certain coverages and what are changes which have come from the 1961 to 2025 Act, and how the Act is better presented in the current format. So with that, I would just start with my presentation. So income tax law 2025 is the need of the hour. Why it is the need of the hour is, as I said, it is 6 decades of continuous evolution. India embarks from a transformative journey. We are trying to grow from a developing economy to a developed economy. To go to that, we need a stable tax structure, a very simplified tax structure, and a very understandable tax structure. So, a lot we had done it with our indirect tax with the introduction of GST in 2017. Now it is the need of the hour for direct taxes, and the income tax department and the central board of direct taxes, along with our ICAI suggestions, have simplified the law where not only a professional or an income tax officer can understand the law, even a common man can be able to understand that particular law. So there have been over 4,000 amendments in the earlier law. The law has gone over a period of 60 years, 64 years to be exact. 4,000 amendments have gone through that particular old act. So it is needed to bring a new act to enable to understand the nitty-gritties and the simplicity of the law. So what are the key features of the new act? So what are the key features of the new act is, earlier act had 819 sections. The current act has 536 sections. Only 536 sections. A lot of sections have been removed. The sunset sections have been removed. Also, certain sections have been grouped. So we will see in our presumptive taxation how various sections have been grouped, so that how easily the income tax law is understandable. Also, the number of chapters have halved. It used to be 47 chapters in the old law. Today, there are only 23 chapters in the new law. So sections have become 3/4 or 2/3 of the earlier laws. The chapters have halved from the earlier laws. So it has become a simpler law. The size of the law also has reduced. If we have all purchased the new Income Tax Act and the old Income Tax Act, you can see the difference in size. Also, for the interest of all the members, the Direct Tax Committee themselves have published the new Income Tax Act. It is available in the Institute portal. So I just wanted to show that it is available in the Institute portal. Also, I would like to thank the Income Tax Department for coming, for showing a comparison between the old law and the new law. So this is the publication of Direct Taxes Committee. They have done a tabular mapping. They have having the Income Tax Act, and all these publications have been done. Also in the Income Tax portal, you have a separate comparison. You have a comparison between the old law and the new law, which simplifies for the users. It simplifies for the users how the law is being presented. So you have a navigator, you have all these various provisions in the income tax law. So you have a navigator. So if you are very well versed in the old law, new law you can easily take. So you know the old law section, search the old section and you can get the new section. You do not like the PDF, there is also a utility to check. So you want to go for a particular section, it is very simple. Say I want to see 44 AD. Now it will be in the new law 58. So you will know which clause to refer, how to see the section in the new law. From the old law to the new law, you can see the section. Return of income is 139. Here it is 263. So all these sections have been placed beautifully by the Income Tax Department. Even our Direct Taxes Committee have given a beautiful comparison of the old law and the new law in the mapping. So both have been done. Both department as well as our Direct Tax Committee have published. So for the benefit of public and all the members to compare between the old law and the new law, because even though the old law, even though the new law is a representation of presentation, one second. So even though the new law is the new law is fresh, it is not very different from the old law, but the law has been simplified for us to understand all these particular clauses. So what is the contribution of ICAI in the new law is, we have given around 90 plus amendments. 93 amendments have been given in the new Income Tax Act. They have also been published in our Income ICAI portal. As I showed before, what are the amendments? 93 amendments have been posted by suggested by the Direct Taxes Committee, which has been accepted by the Central Board of Direct Taxes. So we have a collaborative effort has been done both by the partners of National Building in the ICAI as well as the Income Tax Department, who are very open to taking suggestions from us. So the tax legislation has become simplified. It is easily understandable to all the members as well as the stakeholders. So now what are the changes? What are the key changes which are there in PGBP? Also, I would also tell what are the major changes which are there in law. What are the major changes done in law? What are the major changes done in PGBP? And then I will show what is there in set off and carry forward. Also, a lot of people will be having doubts. Sashank, I have set off and carry forward in the last year in the old income tax law. What should I do in the new income tax law? So all these queries would be there for all our members. So to answer that, I will go one by one in my presentation over the course of the presentation. So what are the changes? So what are the changes in Income Tax Act? What are the major changes or the minute changes which are done? So the first thing, what is the major change which has been done is income definition. This is only in relation to PGBP. Income definition has also included export and import incentives in the income definition in Income Tax Act. So I'll be covering it separately in my separate slides would be shown for this export and import incentives. Then we have done away with previous year and assessment year. The only terminology which is going to be used is tax year. So a lot of people will ask, Sashank, why they are using tax year? Why income tax law could have used the word financial year? Because tax year is anyway going to be from April 1st to 31st March. This is what is defined in Companies Act, which is what defined in various other acts as financial year. Why they have not used financial year and why they have used tax year, that also I will show you the logic behind. It is not very simple. It is not very, very simple what we think that there is no thought process. They could have just done it as financial year. There's nothing like that. Lot of thought process has gone in the law. Lot of thinking, lot of work has been done to recognize why it is considered as tax year and why not as financial year. Also, there is a change in the definition of books of accounts. It has modernized. So books of accounts definition, what are included, what are not included, it has been modernized. So we will see all these various scopes to understand what is the thought process and what are the changes done in the law. So before going to that, what is the key change in PGBP? We will see what is there in export incentive. So export incentive taxation, the earlier law, it was very open. What to do about duty drawbacks, what to do about export incentive. Does it come under capital receipt and you don't need to offer it as income? So a lot of debate, a lot of issues, a lot of discussions, a lot of case laws are there. Whether duty drawbacks is considered as profits or gains of business or profession or whether it is not considered. Whether export incentives can be considered or not. It is now very clarified by the new law that it is a part of income. It is not a capital receipt, it is a part of income. Because it has gone through a lot of dispute over the last 60 years, it is now very, very, very clear that any export benefit will be considered as income. It will be considered as income. So 1961 explicitly named export related incentive receipts which are there. So what all they have told is profits from sale of license under import control order. That would be considered as income. Cash assistance received against export under government schemes. Customs or excise duty drawbacks, they have a specific clause. Only these three were considered as incentives. Only these three were considered as incentives. The other one was open-ended. However, judicial interpretations took that all the export and import incentives to be a forming part of income and not capital receipts. So the new law, what they have done is they have considered every export incentive to be as income. So 249(1)(b) has eliminated those three clauses. They have not told any import license under import control order or cash assistance received and duty drawbacks. They have removed that clause and added a clause that any incentive, all export incentives without naming specific schemes. Because every time the foreign trade policy changes, the government cannot change the income tax act every single time. So instead of that, they have brought it into the income tax law. They have brought it into the income definition covering all export incentives, all import incentives considered for the members. So everything for the assessee or the person, all the export incentive and import incentive would be encompassing profit. It will be part. So what are the export things which are there? Profit on import license, cash assistance received, duty remissions. So any duty reductions, any other export incentives, they will be considered. And all export incentives, whether remission, refund, incentive, or license, are defined in section 26. So section 26 is the charging section. In the earlier law, it used to be section 28 in 1961 law. In the current law, it is section 26. So anything defined in section 26 would come under PGBP, and in export incentive would be coming under profit or gains of business or profession. So the first thing which is very, very important is the charging section. So charging section, you have section 28 as charging section in the old law. In the new law, it is 26. So I have done a small comparison. in the law, comparing between section 28 and 26. This is the charging section. So very simply put, the wordings have become simplified. In the earlier law and the new law, wordings have become simplified. Instead of using following, generally the new law refers to another subsection so that it is easier for you to read. And the new law has simplified the way it is to be read. Instead of paragraphs, they have simplified it into a point form so that it is easier for stakeholders to read the particular act or particular law. So all these are charging sections. So charging section benefits have been given now. So if you see 28.3a, I just wanted to show this. So 28.3a, you see. So 28.3a, 3b, 3c, 3d, if you can see in the screen. So if you see 3a, 3b, profit on sale of license granted under import order, cash assistance and duty of customs or excise repaid, duty entitlement passbook on duty remission scheme, duty-free replenishment scheme. So 3A to 3E is all the benefit. Single clause in the new law. Single clause of 26.2E, profit on sale of import license, cash assistance against export, duty drawback or duty remissions or any other export incentive received or receivable. So even if you get the order that you are receiving, it is this amount of duty drawback or duty remission is receivable. Even if you do not actually receive the duty drawback, you have to offer it as income in the new law. This is what is necessary and this is what is simplification. Rather than having one items and creating confusion and having a confusion whether it is capital receipt or revenue receipt, now it has been simplified. Law has been simplified for you to understand each and every simple clause. So 2025 Act, what all schemes have been included. Earlier, these schemes were not included, which had confusion. Now, because all exports and import incentive schemes have come, all these schemes are included. So remission of duties and taxes on exported products, duty drawback schemes, rebate of state and central taxes and levies, duty-free import schemes, advance authorization schemes, duty-free import authorization schemes, EPCG schemes, export promotion capital gains, capital goods scheme, post-export EPCG, then you have NIRVIC scheme, ECGC, Export Credit Guarantee Corporation, Export Credit Insurance, then you have your SEZ benefits, EOU benefits, deemed exports, towns of export excellence, focus product and market schemes, all these schemes benefit whatever you receive for import and export of goods will be considered as income. So, for example, in EPCG scheme, you are getting the import duty. You need not pay the import duty. Suppose you do 6 times the turnover of import duty, 6 times the customs duty you do export, you need not pay import customs duty if you have the EPCG license. Now that can be offered as income because that import duty which you have foregone or not paid is as good as your income. So these are clauses which are there in your income tax law, which has been a change in the new act. All the incentives have been taken in the new act. The next big change which happened is tax year. Instead of previous year and assessment year, now you have simply put tax year. You have tax year and subsequent to tax year for certain things. So your 43B definition or your 43B payment or your return of income filing. So all those uses subsequent to tax year. What is tax year is replacing the previous year definition. A lot of people in the old law had confusion of previous year. Why they had confusion is previous year income would be assessed in the assessment year. You have to file the return of income in assessment year, offering the income of previous year. So right now we are in assessment year 26-27. The previous year is 25-26. A lot of common man are not able to understand the logic of previous year and assessment year. So instead of using the previous year, the current law uses the word tax year. So currently we are in tax year 2025-26. When we have to file our return of income is subsequent to tax year 26-27. So tax year is a single year which is going to be used from now onwards. To avoid all confusions, it is just one single word, tax year, which is equivalent to financial year. How it is equivalent to financial year is tax year begins from 1st April and ends on 31st March. It is a period of 12 months contained in financial year and used for income assessment and tax rate application. The terms previous year and assessment year actually created a lot of confusion, so it has been removed. The term tax year, why we are bringing it is it's globally aligned. So New Zealand, Canada, UK, all these Commonwealth countries also use the word tax year. They use the word tax year, so that is the reason why it is there. How it is different from financial year, I will show you in the subsequent slides. Why financial year is different from tax year? What is the reason that financial year is different from tax year? So tax year is a period of 12 months contained in the financial year. It replaced the term previous year. Further, with this, assessment year is no more going to be considered. It is no more going to be considered. So assessment year and previous year created a confusion. Why tax year? Why tax year and financial year is different is a tax year can be a period lesser than financial year in certain circumstances. So financial year is always from April to March. Even if you prepare your books of accounts in company law, say a company is formed for 6 months, we will say period and we will not say for financial year. We will not say profit and loss for the period. Say a company is incorporated on 1st October. We will not say profit and loss for the financial year 1st October to 31st March. This is not the common parlance. What would be generally done is profit and loss for the period 1st October to 31st March. Whereas income tax law is beautiful. Tax year can be lesser than financial year. It can be lesser than financial year in certain cases. How it can be lesser is, say the company is incorporated on 1st October, you can write tax year for the, profit and loss for the tax year 1st October to 31st March. So even for the period lesser than a year, it can be considered as year. It can be considered as tax years. So a tax year can be a period lesser than financial year. However, many actions carried out by tax authorities, you can consider tax year lower than the financial year. You can consider the tax year lower than the financial year. So can a tax period be lesser than financial year? Yes. When the business comes into existence till 31st March, you can consider. Sashank, is it only for companies? No. A partnership firm can start in between. You can get PAN in between. A trust can start in between a year. So for everyone, tax year is from the period of starting till 31st March. So for the first year, the tax year would be for a period lesser than. So that is the beauty of the new income tax law. That is why you are not having financial year as definition and you are having tax year. A lot of members would have told, why tax year? Why tax year? Why no financial year? Why tax year? Because tax year can be lesser than financial year or equal to a financial year. So less than or equal to a financial year, it is possible. That is why tax year definition is very, very, very crucial. The new act also has only 5 heads of income like the older act: income from salary, income from house property, PGBP, capital gains, and income from other sources. So other changes which are there, the small changes which are there, I just wanted to show is charging section. They have added the word TCS. So income tax paid, income tax payable, less advance tax and TDS was there in section 4. Now the current section 4, they have added TCS receivable also, which needed to be done, which was an inherent understood part of income tax law, that TDS was there. So TCS also should be included as a reduction. Now it is very, very clear that TCS is included. So all these are improving the old act. It is improving the old act. It is not. It is enhancing the old act. Old act, there has been certain omissions which have been carefully curated clause by clause, and TCS, like this, TCS has been added. The second one, place of effective management, they have now made it only for companies. So this is all for your double taxation avoidance. So place of effective management for residential status, it used to be entity with place of effective management. Now place of effective management is only applicable for company. Then curative amendment has been made for buyback of shares. So that will be covered under income from other sources and capital gains chapter. Then multiple changes have been done in section 9. Section 9, the accrual, so the deeming provisions and the accrual provisions, there have been changes in the new law that would be covered separately. Eligible investments fund. Eligible investment fund, the cap has increased from 20% to 25%. A deduction can be now given up to 25% for a lot of people in eligible fund. Also, in DTA, so very, very important thing is double taxation avoidance TT. A lot of words, there are confusions. So you can read central acts or central laws to understand or interpret the treaties. So term defined in central act can be used in understanding treaty. Before this particular amendment in section 159, the earlier section 1990A, there was a lot of confusion whether I can use the central act word or not in double taxation avoidance agreement. Now it is very clear. Now it is going to reduce a lot of case laws and judicial precedents, where we are going to have whether we should refer Central Tax Act or not, whether we should refer central acts, central laws. Today you can. Any reference you can use in Central Act to understand certain words mentioned in double taxation avoidance agreement. And now coming to the main chapter. What are the changes in profit or gains or business or profession? The first change we saw was, because income has been changed and the charging section has been changed, export incentives I've already shown in my earlier slides. So export incentives, all import incentives are considered. Earlier law had only from clause 3A to 3E. Now it is very, very clear. A lot of other items have been added or included in the provisions. So now, other than that, what are the next changes? So I wanted to show a beautiful change in depreciation, a beautiful change in income tax law, where there was a lot of small misuse or not loophole in the law, in the earlier law. Now they have plugged in the loophole for your additional depreciation. So additional depreciation, They have plugged in a loophole in the earlier law and the current law. Beautifully done for additional depreciation. So earlier, for additional depreciation, a second-hand machinery cannot be put to use. So the 20% additional depreciation was given for manufacturing entities or power production companies. They should be put to use and it should be new at the time of acquisition. New means they shouldn't have claimed depreciation earlier. They shouldn't have claimed depreciation earlier. The assessee shouldn't have claimed depreciation earlier. So I'm just showing the old income tax law. I'm just showing the old income tax law for the benefit of the members. In case of, so section 32 subclause 2A had additional depreciation. In case of new machinery or plant other than ships or aircraft which have been acquired and installed after 31st day of March by an assessee engaged in the business of manufacture or production of article or thing in the business or in the business of generation, transmission or distribution of power, a further sum equal to 20% of actual cost of such machinery shall be allowed as deduction in chapter 2. Provided further, no deduction. This is a sunset clause, so I'm not putting this proviso. It has been repealed. This proviso has been repealed because it is up to 1st April assessment year 15-16. So provided further, no deduction shall be applied in respect of machinery or plant before its installation was used within India or outside India by any other person or by any plant and machinery installed in office premises or residential accommodation, including accommodation of guest house or any office appliances or road transport vehicles or any plant and machinery, the whole of actual cost which is allowed as deduction in computing income chargeable under the head PGBP of any assessment year. For example, 35 AD deduction or 35 deduction which have been considered cannot be considered here. So you had a lot of words put here. You had a lot of words put here telling that it should not have been used either within India or outside India by any other person. Second one is, it shall not be used in residential premises, guest house or office premises for additional depreciation. Third one, road transport vehicle, it cannot be used. Fourth one, scientific research or specified business, it cannot be used. The new law is even more beautiful in their depreciation understanding. It has the understanding in depreciation in the new law is even more beautiful, where you can see here they have used the word additional. So 33. So depreciation is section 33 in the new law. 33.8 is going to tell your additional depreciation. In addition to deduction under subsection 3, additional deduction in respect of depreciation for any new plant and machinery shall be allowed when the assessee is engaged in the business of manufacture, of production of article or thing, or in the business of transmission or distribution of power. So you can read the old law and new law. So if you see the old law, you are having paragraph. See, assessee is new manufacture, plant and machinery, generation, transmission. So all these are given in separate clauses. Beautifully put. See, if you have a separate clauses for this, you have a separate clause for this. Assessee acquires and installs a new machinery and plant, and new machinery is first put to use. So first put to use in by the assessee. So anyway, this clarifies those 4 points. But still, to safeguard, they have given the earlier clauses also. It should not be used in within India and outside India. It cannot be used in office premises or guest house. Earlier, it was just put to use. It is there. The earlier word was just put to use. Further sum of 20% shall be allowed. New machinery or plant which has been acquired or installed by an assessee engaged in the business, additional 20% is allowed. They have not told first put to use. Now it is very, very clear that it should be first put to use in business. It should be first put to use for manufacturing purpose. It should be first put to use for business purpose. So what can be the change, Sashank? Why it is a very important term? Why first put to use is a very important term? Because in the earlier law, say I've not used first put to use in business. I've not used it anywhere. I've not put to use. It is still there. Machinery, you have to take depreciation only if it is put to use. There was an open-ended that say I've not first put to use in business and I've not claimed depreciation. Then I'm putting to use in business and I'm claiming additional depreciation. Can it be allowed? Earlier law, there was a confusion. To avoid that confusion, it should be first put to use in business. First put to use in business purpose. So you need to put to use in business. So that is what is beautifully constructed here. Beautifully constructed here. First put to use. So if the assessee uses for non-business purpose first, additional depreciation will be denied. Sashank, what is non-business purpose? Earlier law also you had non-business purpose. Residential you cannot use. One second. You cannot use for residential purpose. You cannot use for guest house. You cannot use for office purpose. Yes. But what if I had let it out? What if I had let it out to another person? I have leased it out. It is not used in my business. It has been leased out and I'm claiming depreciation. Could it be allowed? Maybe allowed. Now it is first put to use by the assessee for his own business purpose. Business purpose. First put to use for business purpose. So you cannot lease out to another person and claim depreciation. Now it is very, very clear. Law is very clear. First put to use for business purpose. It cannot be put to use for non-business purpose. This is where the new law is beautifully drafted, beautifully presented, where a loophole has been plugged. Lot of judicial precedents and judicial discussions have been reduced. So a lot of things have been done in the new law. So conditions have been tightened. It is simpler to understand. As you saw the law, the new law is more beautifully phrased. The new law is much more beautifully phrased than the old law. Old law is not as beautifully phrased because you do not have paragraph by paragraph. You have a full paragraph, very clunky to read. New law, you have point by point, very easy to read, very easy on the eye, very, very easy to understand. Beautifully drafted new law. This is the first change in this particular law. Second change, which is there in the law. Very, very important need of the hour. Sashank, what need of the hour? One new section 29 has come for all the employee benefits. So you had earlier all the employee benefits or any employee benefits, say employees contribution to provident fund, employees contribution to superannuation fund, any gratuity payment or provident fund payment, all these provisions. Suppose they are doing to unrecognized gratuity fund or unrecognized provident fund, all these benefits were there in different sections. I had to refer section 36. I had to refer section 40. All these sections I had to refer. Today, very simply, very simply, you have to just refer section 29 of the new act. So I'm just going to show a beautiful comparison. I have presented the comparison of the old law and the new law, where the employee benefit or the employee welfare, how it has been shown, how it has become simplified. So the old law, you had deductions in 36, you had deductions in 40, you had deduction in various other clauses. Now here beautifully put, section 36(1)(4) is for employer by way of contribution to recognized provident fund or superannuation fund. So this is there in section 29(1). 36(1)(5), which is there in 29(1)(c). Any sum paid by the assessee as a way of contribution to approved gratuity fund created for the exclusive benefit of employees under an irrevocable trust. Now it is coming in section 29(1)(c) as a deduction. 36(1)(5)(a), which is for income. Any income received any sum received by the assessee from any of his employees mentioned under subclause 10 of 224. So if you see the old law, subclause 10 of clause 24 of section 2, new law you read. The amount of contribution received from an employee to which the provisions of section 249O. We understand it is subclause. We understand this is clause 49, subclause O. So they have made sure that the people or the stakeholders who read the law understand how to read the law. Instead of complicating and adding the number of words, being a very verbose act, very not understandable act, very simplified act. So all the employee benefits have come under the beautiful section of 29. Also, I will show another beauty which has come, which is very, very beautiful. What section has come is section 66. So I will show section 66 in the end. That is also a very beautiful section which is going to have all the definitions. All the definitions are going to come in section 66. So as you can see, even your 40A7 is coming under section 29. So 40A7 is subject to provisions of clause B, no deduction shall be allowed by the assessee for payment of gratuity in termination for any reasons. So this is come under section 29. Also your 40A9. No deduction shall be allowed in respect of employer for formation or contribution of any fund or trust where such sum or any other institution except where it is paid for Provident Fund. So except where it is paid for Provident Fund, 40A9 is there. Now that is come under section 29. Beautifully put. New law is so beautiful that all these things have been put under one particular subclause. So from section 36 and 48, you have only one beautiful section of section 29. Beautiful. This is what, so the structural organization has been simplified. So any employee section, refer section 29. You need not refer the older section. You just need to refer section 29. You need not refer 4-5 sections consecutively together. Beautifully presented. This is what is the purpose of the new income tax law. Now, the next thing, major change, which is there is a small change in non-resident salary section. So 40A3. So this is responding to deductibility of salary made outside India's or to non-resident. They have tightened the compliance. The earlier law under section 40A3, deduction was disallowed when both conditions were met simultaneously was the interpretation, because the law used tax has not been paid under chapter 17B nor tax has been deducted. So they used a double negative. So instead of interpreting it as or, both have not been satisfied. So it has been read as both has not been satisfied. So I will just take out the section for the members' benefit. I will just take out the section 40A clause 3. This is a minute change in the new law, but it is being done clause by clause. 40A3, is it used much in practical? It is a very minute transaction. Only 1% or 2% of transactions are there in 40A3. But still the focus has been done by the income tax department. So any person, any payment on which salary is chargeable, if it is payable outside India or to non-resident. So this is the earlier 40A3. And if the tax has not been paid thereon nor deducted. So they've used the word if tax has not been paid nor deducted under chapter 17B. So this created a confusion. Neither paid nor deducted means both paid and deducted. Can we interpret it that way? That had created a lot of judicial confusion. So today, for clarification of the law, they have simplified that it will disallow if either of the condition is met. TDS is deductible but not deducted. TDS is deducted but not paid. So beautifully, the new law has simplified whatever complexity was there in the earlier law. Earlier law, what complexity was there, now it has simplified. So Sashank, can you show me the section? Yes, sure. So if you see the section, beautifully put. New law has beautifully put any payment chargeable under the head salaries, payable outside India or to a non-resident on which tax is deductible and such tax has not been deducted or after deduction not been paid. Very clearly put. Now, what has been the benefit of this is, what has been the benefit of this? Sashank, what is the benefit of this? This has become like your earlier section 40, A subclause, clause A, subclause 1A, or clause A, subclause 1, where TDS has been deducted, not remitted, you have to disallow, or TDS has been not deducted. TDS has not been deducted, you can disallow. Earlier, there was a confusion. It was that both it should not have been deducted nor paid. So a lot of people, what they did, they passed the deduction entry and not paid the salary, not paid the TDS. That doesn't, it was not right. A lot of judicial precedents were there. Now that has been reduced. Also, one beautiful thing is for this provision, clause 3. For this clause 3, what is there is, for your non-resident and resident, your normal chapter, whatever was in 40A clause 1 and 40A clause 1A, suppose you have not remitted within the previous year and you have remitted within the due date of filing return of income, it was allowed. In the new law also, if you have not remitted in tax year and you have remitted or within the due date, but you have remitted before the filing of return of income, it is allowed as a expenditure. Whereas for this particular clause 35C, this grace period is not extended. So while sections 35B, 35B2 and 35D, TDS payment is allowed up to the date of filing return of income. It is allowed. It is not allowed for 35C. Sashank, why? Again, this is a beautiful plugging of loophole, because non-resident taxation or transaction outside India, it is harder to recover. While filing 15CB itself, Form 15CB in the earlier regime, you had to show the tax paid. If something is going to be paid, salary or TDS is going to be paid, that should be disclosed. The deduction should be disclosed in Form 15CB and you're required to be paying within the due date. Suppose an assessee doesn't do that for non-resident, it is harder for the tax department to collect the tax from the non-resident or collect the tax from outside India. That is the purpose why this particular clause has been added. Why this clause has been added again? This is for payments, salary payments to non-residents or payments outside India, which accrues or arise in India. So for those payments, TDS has to be deducted immediately and remitted immediately, so that it is easier for the compliance, or else it's harder for you to follow. So it is allowed only when not the due date period is not given for this subsection, it is given for the other subsections. So that is why beautiful thought process, lot of thinking has been done in this particular law. And another beautiful change which is there in the new law is whether surcharge is a deduction or not. Earlier 43B of Income Tax Act doesn't mention surcharge. I will show you 43B clause A and section 37, the particular clause. So Income Tax Act allowed deductions on accounting basis, cash basis or mercantile basis under 43B, where upon payment it can be done. 43BA does not mention surcharge, whereas 37.2A specifically mentions surcharge. So Sashank, can you show me the same? Yes. So 43BA. Earlier law, when the law was formed, surcharge was not there. So any sum payable by assessee by the way of tax, duty, cess or fee by whatever name called under any law for the time being in force. There was no word surcharge there. Today, the new income tax law beautifully in 37 clause 2A has presented surcharge. Tax, duty, cess, surcharge or fee by whatever name. Also, one thing I wanted to show in the new Income Tax Act, since we went past 36, what I love about the new Income Tax Act is a lot of tables are presented in the law. So for specified person definition, if you see in 36, what used to be section 40A, 48.2. Now here, Now here they have given table presentation. Earlier law, it is not as beautiful table as here. It is somewhat in a tabular format. The new law, you're having tables. More than this, I will want to show my presumptive taxation and my scientific expenditure. Beautifully presented. Beautifully presented. Slowly I will show. So clause 37, section 37, I showed you. What is there? Surcharge. Confusion. Whether can I claim surcharge as an expenditure or not? Lot of confusion was there. Customs duty, I paid some surcharge. Can I claim it, Sashank? Today you can. The new law is very clear. Very, very, very clear about surcharge being included in the same. Small changes, but big practical impact. So 2025, also one very, very beautiful thing, since we are discussing 43B, I want to show one beautiful thing. The earlier law, so the earlier law, you had to evidence payment. One second. So the earlier law, you had to evidence payment as per your income tax law. You had to show evidence that it is actually paid within the due date in 43B. Along with return of income, you had to show evidence of the same. In the earlier law under 43B, even though practically we are not showing in our return of income, we had to show it while filing the same. Oh, I was in 40A. So earlier law, in return of income, I had to show it in 43B, the evidence. So evidence of such payment. It was there in the proviso clause. So if you see earlier law, for 43B, provided nothing contained in this section except provisions of 43BH shall apply in relation of sum actually paid by the assessee on or before the due date applicable for furnishing return of income under subsection 139(1) in respect of the previous year in which liability is incurred as aforesaid, and evidence of such payment shall be furnished by the assessee along with return of income. Practically, a lot of members, a lot of practice, nobody has not attached this additional attachment. By law, under 43B, you have to suppose you have not paid within, for example, bonus. So in India, bonus you pay within 8 months. 8 months is given in the law for the year. Bonus provision would have been made on 31st March. Generally, it would be paid during Diwali time. In income tax law, since the due date for filing return of income is 31st October, generally, if you file the return of income, you pay bonus on 25th October before Diwali. On 25th October, you pay, which is before 31st October. Can you claim as deduction? Yes, you can claim as deduction. But are you showing that evidence of payment of bonus to income tax department with the return? Most of them practically are not showing it today, but by law, it is required. By this proviso clause, it is required. But the new law has removed that clause. You don't need to show evidence. All you need to do, so read subsection 3. In case of amounts specified in subsection 2, except whatever is mentioned in G, micro, small and medium enterprises are paid after the end of tax year in which liability is incurred, but before, on or before due date of filing return of income under 263, deduction shall be allowed for such tax year. Here what they have given, deduction is allowed only if the evidence. So payment is done before due date and evidence of payment is given. And evidence of payment shall be given. So, Sashank, practically I have not done it further. Practically you do have evidence. Where you have evidence is, at least in tax audit cases, you have evidence. Tax audit case, what evidence you have is, tax audit case, you have evidence of filing it in under clause 26, clause 26B of your tax audit report, where you will show that 43B payment have been done before the due date. which is pending on the last date of the year and paid before on or before the due date. Beautifully put. Here, you don't need to show evidence. In the new law, you need not show evidence. Earlier law, practical difficulties. Imagine the thought process gone. Lot of members are not practically filing. Leads up to litigation. You should have shown evidence. New law from assessment year for tax year 26-27 onwards. Beautiful. You need not show evidence. You have to just claim deduction if it is paid. In assessment procedure, they will ask evidence, or your tax audit report already has evidence. So a lot of thought process has gone under the law. So documentation has been reduced. So 43B must be allowed on payment basis. Two significant modification. One modification was adding of surcharge. Second modification in 43B, the earlier 43B and current section 37 is you need not show evidence. You need not give evidence of payment along with your return of income. Practically, which is not being done by a lot of people while filing their return of income. Lot of assessees. Today, the income tax department accepts the practical difficulty and have brought it in the new law. Beautiful. Next one, we will see the account maintaining. So books of accounts is the next part of the topic. Before going to that, I just wanted to show how beautiful the new law is for a lot of clauses. I just wanted to show where tabular representations have been made beautifully in the new law. So I'm just showing section 46. So I'm going to show certain sections. First section I want to show is section 39. So section 39 of the new act as compared with section 43 of the old act. So 39 of the new act, you can see in special cases where the cost of the previous owner would be the cost of the next owner. So when by amalgamating company, it is transferred to amalgamated company, actual cost to amalgamated company would be what is there as per amalgamating company. So the same thing in the old law in section 43 is not shown as beautifully as this. So I'm just so if you see in the old law, so it will be in explanation 7. The old law, if you see, one second. So old law, if you see, it is there in explanation 7. In the new law, you see, beautifully put as table. One by one, you have explanation. In the old law for demerged company, it will come in explanation 8. So old law, it will be coming in that particular explanations. So 7A, it will be coming under explanation 7A, demerger. So all these clauses in the new law, they've presented it in a beautiful format. They've presented in a tabular format. That is what the new law has done. It has reduced the complications. It has reduced the complications as per the old law and the new law. Beautifully shown. Beautifully shown in the new law. Tabular format. Cost of old, cost of new. Inventory converted into treated as capital asset, fair market value. So each case they have given what is the actual cost of asset. They have summarized a lot of sections. They've summarized a lot of sections and they are showing it here. When asset is acquired by assessee by gift or inheritance, beautifully put here. So all these are clause by clause, a lot of thought process have gone into the new law. Broken down and beautifully shown in the new law. One more beautiful thing I just wanted to show is 35 AD. 35 AD is currently section 46. 48. 46. So if you see section 46, 35 AD, all these are 35 AD specified businesses. So if you see the old law for 35 AD, it is not as beautiful as what it was now. So all these presentations have improved under the new law. So if you see the old law, what all are specified businesses, it comes under clause 5. On or after the first day of April 2007. in the laying and operating of cross-country natural gas pipeline. 2010, on or after 2010, building and operating a new hotel, building and operating a new hospital after 2010. See the new law. How beautiful, beautiful presentation. You don't even need to see as per laying. Simply the starting word is laying and operating a cross-country pipeline from this date. From which date it is given here in a table format. So what our reckoners used to do, the new law itself is doing. Earlier, what all the reckoners used to do, the new law itself is doing. Income tax department has, CBDT has seriously improved the new law. Reading, understandability, a common man can understand. For these businesses, capital expenditure, he can get 100% deduction. He can get 100% deduction, beautifully put in the new law. So you can easily see all these things, class by class. Whereas in 35 AD, you have the same class. So you have the same 13 classes. But see how they have formed. A, AA, AB, AC, AD, AE, AF, AG, AH, AI, AJ. So the presentation is not that neat. Here it has been preserved beautifully. The new law has done it beautifully. The next thing which I wanted to show in the new law and the old law, what is the major changes? They are in books of accounts. So since we are doing books of accounts, I also wanted to show books of accounts. Before that, I just wanted to show one more thing in presumptive taxation. I'll do books of accounts and then I will do presumptive taxation. So books of accounts maintaining comes under PGBP. Method of accounting comes in, it comes in a separate chapter. So method of accounting comes in section 145 in the old law. Under the current law, it is section 276. So 276 is under the new law. So books of accounts, we will just see what is there. So books of accounts, proper books of accounts to be maintained. Earlier law and the new law, there is not any change in the books of accounts maintenance, but the presentation has improved. The presentation has improved. Earlier law, you had a proviso for individual or HUF. The new law is very clear. Earlier law, specified professionals, you had to maintain books of accounts. So who are specified professionals? New law beautifully shows. So new law for specified professionals beautifully shows as comparisons. Who are specified professionals? So the new law under section 62 provides for books of accounts. So I'm just showing a comparison between old law and new law. So specified professional, new law is categorizing it in 62(4) directly. Who are the specified professional? So if you see the earlier law, they had legal, medical, engineering, architectural profession, or the profession of accountancy, technical consultancy, interior decoration. Here beautifully put, legal, medical, engineering, architectural, accounting, technical consultancy, interior decoration, information technology, or company secretary. Why these two are there is they were notified by the board in official gazette. Today it has come under the law. Earlier there was a notification. Today it has come under the law itself. Information technology professional and company secretary, they have to maintain books of accounts. Earlier law, you had a proviso for HUF and individuals. For maintaining books of accounts, you had a proviso for HUF and individuals. So where for HUF, the gross receipts, the word, instead of the word 10 lakh rupees, 25 lakh shall be done. The new law beautifully put. In case of HUF or individual, extent modified is up to profession excluding, the extent of income is up to 2.5 lakhs and the gross receipt is up to 25 lakhs. Here there were two separate provisos. Provided in case of person being an individual or HUF, the provisions of clause 1 and clause 2 shall have effect. Instead of the word 1,20,000, it should have the effect 2,50,000. And instead of the gross receipt having 10 lakhs, it should have 25 lakhs. Now the new law is very simple. You read the law, it is very simple. For individual and HUF, the limit is 2.5 lakhs income and 25 lakhs gross receipt. The same thing is only carried forward in the new law, but the wordings has become simpler. It is very, very simple for the assessee to read and understand. My most beautiful provision, I'll come later, is presumptive taxation. Beautifully done. So anyway, so coming to books of accounts, Specified professional, all specified professionals should maintain books of accounts. Non-specified professions, individuals or HUF, 2.5 lakhs up to 25 lakhs. Others, 1.2 lakhs up. Gross receipts is 10 lakhs. Business also the same thing. So any person who is doing 44 AD, suppose their income exceeds basic exemption limit and has opted for presumptive scheme, they have to do. So all these I will be showing. Whatever is there in the old law is there. If you're declaring lower than your presumptive scheme, you have to maintain books of accounts. You have to maintain books of accounts for all the presumptive schemes. So section 58 is going to be presumptive for 44 AD, 44 ADA and 44 AE. And your 61, 44C is 59. And one more is 60. 61 is going to be for your 44BB, 44 BBA, BBB, BBC, BBD. All these sections are going to be under 61. So presumptive taxation are just there in 4 different sections, and tax audit is also going to be there in 4 different sections. So suppose you are declaring lower than that, you have to show. For 44B, anyway, it was mandatory. It is mandatory in every case for non-residents engaged in shipping business. In aircraft business, it was mandatory in every case. Now also it is mandatory. Suppose you are claiming lower than deemed thing for non-resident in mineral oil, it is applicable. So all these are there. Whatever is there in the earlier act is applicable in the newer act also. So 44 BBC is operation of cruise ship, which is mandatory. 44 BBD is technology services or setting up electronic manufacturing facility, which has come only in the last year's act. So that also is presented beautifully. So I will just show you presumptive taxation scheme, how beautifully they have done in the new income tax law. Very simply put, very simply understood. The same clauses which were there. So 58 is going to be your first presumptive scheme. So before you had the notwithstanding clause, here provisions of 26 to 54 to the extent contrary to this section shall not apply. So this section overrides those sections. So notwithstanding those section contrary, all this we have given. Now simply whatever is contrary, it shall not apply. For specified businesses in 2. So column 2 beautifully put. So what is this table 2 is? This is going to be 44 AD. This is 44 AD. Any business other than the business specified against serial number 2. So serial number 2 is 44 AE business. Business of flying, leasing, goods carriages, all eligible assessees, total turnover does not exceed 2 crores. So it was 2 crores. If cash receipt or cash payment, cash receipt does not exceed 5% of turnover, you can go up to 3 crores. So beautifully put here as 2 clauses. Does not exceed 2 crores or does not. In the earlier law, you had a proviso, 2 crores, provided that less than 3 crores. Now there is no proviso. Beautifully put in the new law. The same 6%, 8%. So you can read. A person who doesn't understand Income Tax Act, he can see the section. Business, eligible assessee. 2 crores, he can show 6% if it is received in banking channel. 8% if it is not received. Also, 6% should be done on or before filing the return of income. You can claim only if it is tax paid is before the due date specified in respect of tax year. So specified flying hiring businesses, carriage hiring, 1,000 per vehicle, 7,500. Specified professionals, you have up to 50 lakhs or 75 lakhs if the gross receipt is, if the non-cash receipt is, if the cash receipt is less than 5%, does not exceed, less than or equal to 5% of total gross receipt, you can show 50% or amount whichever is higher. So beautifully put, 6% or amount whichever is higher, 8% or amount whichever is higher. So beautifully put in the new law. So presumptive taxation is beautifully put. Also, one more beautiful part of presumptive taxation is this. Any assessee mentioned in column C. So column C is specified assessee who claims that profits or gains actually earned from specified businesses are lower in the manner mentioned and whose total income exceeds maximum amount which is not chargeable to tax is required to maintain books of accounts and shall get his accounts audited. So this audit provision, which was there, one very, very important thing because of this clause. Earlier in 44 AD, in the year of declaring lower than 6%, you need not do tax audit. Only in the subsequent years, as per 44 AD4, you needed to do audit. That has been removed. I mean, that is still there. That is still there. Basis of this provision, clause 3, 44 AD, you are declaring, even in the year of declaration, you are declaring lower than 6% or lower than 8% for non-cash transactions, and your basic and your income exceeds the maximum amount not chargeable to tax, that is basic exemption limit, you have to maintain books of accounts. Also, you have to file your tax audit report. You have to file your tax audit report. Also, one beautiful thing is 44 AD and 44 ADA, this partner's remuneration was not allowed in the earlier law as per 40B. 40B. In the new law, section 58.2, only serial number 2, partner's remuneration is allowed. 44 AE also had a proviso which told that partner's remuneration can be allowed. Same thing is there in the new law for the subsection 2, table 2. So table 2 is this. You can claim partner's remuneration as per section 35E. So this is beautifully put. Also, where an eligible assessee declares profit for the year as per provisions of 2, and he declares profit for the 5 tax years, then he shall not be eligible to claim provision benefit for 5 years. Whatever was there in 44 AD4 continues in 58. It continues in 58. So this is beautifully put. So this table is beautifully put. Also, section 61, I just wanted to show. 61 also, all your 44B, 44BB beautifully put as a table so that a member can easily understand the same. Also, next thing I just wanted to show is tax audit clauses. Also, books of accounts, one more small change has been there. Books of accounts, one very, very important wording has been added as per clause 219 of the new Income Tax Act. So clause 219 of the Income Tax Act also includes the word cloud-based storage. Cloud-based storage. So earlier law, you had the definition as ledger, day book, cash book, accounts books, or any other book kept in electronical or digital form. Books of accounts to include ledger, cash book, day book, accounts books, whether kept in written form or printed data form or electromagnetic form. Now, books of accounts you have shown in cloud-based storage is also included in books of accounts. Also, one more thing I just wanted to tell in books of accounts is in search and seizure provisions in section 261 in the new law, computer system has been defined, virtual digital space has been defined, asset has been defined. So all these are physical records or vouchers that the department can see or verify for the income. So computer system includes, so computer system has been defined, telling that physical computer and networks, computer resources and communication devices, that includes your mobile phone, digital or electronic data storage, that's your hard disks, remote servers and cloud infrastructure. So those are also included. Virtual digital spaces, we will see what is virtual digital spaces separately. So these components may operate separately. So all these can also be seized. In search and seizure, these also can be verified and seized. So what is virtual digital spaces? Environment constructed through computer technology, distinct from the physical world, enabling digital interaction and communication. So email servers, messaging platforms, social media accounts, online investment trading and banking accounts, website documenting asset ownership. So your crypto, all these will be there. Remote servers and cloud storage, digital application platforms. So what all have been included is your WhatsApp, your Telegram, your Aratai, your cloud storage, your Google Drive, your Dropbox, your crypto wallets, your Google Pay, your UPI payment systems, DMAT application, everything comes under search. And then assets, possess assets. You can not only possess traditional physical assets, you can also hold assets which are in virtual format. So your digital gold, your money, bullion, jewelry, virtual digital assets, your cryptos, your valuable articles, all these can be held today. Cryptocurrencies, non-fungible tokens, so all these can be held by your department. Anyway, there's a separate chapter for assessment, search and seizure. Why I wanted to bring this is in books of accounts, these also can be considered in your procedure. So cloud-based storage is included. Why, Sashank? Earlier law didn't have, they had only the word digital. They didn't have the word cloud. Cloud is the new form of maintaining books of accounts. A lot of people maintain their accounts in cloud-based format. Server is there somewhere, accounting is there somewhere. So that is the need of the hour. So cloud-based system is also included. Presumptive taxation, I beautifully showed how presumptive taxation is there. Audit requirements, again, audit requirements also section 63 beautifully has a table and it has simplified the earlier table. Every person carrying on business, if his total turnover exceeds 1 crore, subject to provisions of class B. Earlier there was a proviso. The class B says if aggregate of amount received does not in cash does not exceed 5% of said amount, and aggregate of all payments incurred for expenditure does not exceed 5%, 1 crore can be substituted for 10 crores. Carrying on professions, the amount is 50 lakhs. Also, if the person is carrying on business or profession under 58.2 or 61.2 and profit claimed is lower than the deemed profit. So as I told earlier, 58.2 table, they have not told serial number 1, 2, 3, they have told table 58.2. So 58.2 has your earlier 44 AD, ADA as well as AE. So you declare lower than that, you have to do under 63 clause 2. So provisions of section shall not apply if it is for 58.2 or 61.2. So if it is declared as per 58.2 or 61.2, audit section is not applicable. Audit section is not applicable for the same. So these are the changes in PGBP. So method of accounting and set off or carry forward, I'll do a quick comparison. Majorly, there is no change in that. Sashank, is there a change in that? Majorly, there is no change in that. So I'll just do a quick comparison. So there is no change in set off and carry forward. Only one thing I wanted to show is the repealing clause provision. What happens for the earlier years? And then I will end the seminar. So method of accounting, since it's forming part of the chapter, so it's the same clause. There is no change. 276 and 145 are remaining the same. Also the same clause where the assessing officer is not satisfied about the correctness or completeness, method of accounting or income has not been done as per accounting ICDS, best judgment assessment can be done under 271. Same thing which was there in the earlier law 144 and 145. Set off carry forward, they've simplified the words. Instead of using save as, otherwise they've used unless provided. And the set off carry forward, beautifully they have done chapter wise. Neatly they have presented so that it is very, very easy. Now, Sashank, what is the most important aspect? Set off and carry forward. I've carried forward till assessment year 26-27. From the new law, that is previous year 25-26. From new law, how do I carry forward? Can I carry forward? In Income Tax Act, the most important provision, this needs to be covered. It is section 536. So 536 is repeal and saving section. Go through this section fully for the transfer from the old law to new law. This is the transition provision given in GST, which is given in the new income tax law. So the repeal and savings provision as per 536 is the most important provision. So just going to finish this before my doubt session. Any amount of loss. So the clause M of repeal provision is very, very clear. Clause M, clause N, clause O is all very, very clear. Any amount of loss under the source of head of income under column B given below in the section of repealed income tax under column C of the said table brought forward for the tax year beginning on 1st April 2026 shall be had the earlier act not been repealed, shall be set off and carried forward against the income computed in the manner as specified in the earlier law. So whatever was there in the earlier law, it can be carried forward. So as per 1/4/2026, had the earlier law, whatever was there. So 1 crore loss I have claimed, that same 1 crore loss can be carried forward. So house property, PGBP, speculation business, specified business and horse race. Sashank, what about capital gains? It is there in the next section. And what about additional depreciation or depreciation in amalgamation, 72A? It is there in clause O. What is about 72AB? Clause P, it is there. So beautifully it has been put. Even this section is there for Sashank, what about 115 BAA, BAB, BAC, all these special tax regime? That is also being carried forward here. So the new law is beautifully constructed. It has been beautifully presented, and it is very well drafted. Any changes, minute changes, always the income tax department is willing to listen. Also, direct tax committee, being member of the committee, they're very open. Any suggestions, any words, any publications, they're very open to hearing any suggestions from the members or professionals or public as such. So yeah, please do give your suggestions and any queries, any doubts and queries, sir. I will be willing to answer now. Thank you. Thank you.
Thank you, Shashank sir, for a very enriching and enlightening session. Now I request all the members who have put their questions, we're going to ask questions to Shashank sir one by one. Shashank sir,
Yes.
question has been placed. What will happen to the carry forward losses which we have taken in the assessment year 25-26?
Sir, 536, I mentioned the repeal and savings clause. So 536 MNOP, all these would be helping the carry forward of the earlier loss. So that was very, very important.
One more question was there. Please explain the provision of presumptive taxation under the new Income Tax Act. You have already said that thing.
Already said 58 and 61, 58, 59, 60, 61 are for the presumptive taxation. The table is beautifully put for the same.
One question was that there are many machinery suppliers who are selling refurbished machinery for new setup. What will happen in this case for depreciation?
Additional depreciation cannot be claimed by the manufacturer because of the word first put to use. And even in the earlier act, if it is it's a second-hand machinery, you cannot claim depreciation used in India or outside India by any other person. You cannot claim the same. So the same holds today also.
No additional depreciation will be there. Thank you, sir. Where depreciation schedule is now in Income Tax Act, whether there is a depreciation schedule is now in Income Tax Act.
Yes, sir. Depreciation schedule will be there. The repealing and savings provision helps us to carry forward whatever is the old WDV into the new act. So whatever is the old WDV will be taken as the new WDV.
So we have received a 4-5 question from the same person, CA Anurag Mishra from Lucknow. He has a doubt. सर वो डाउट ऐसी है कि उन्होंने डीएसए लेके रखा है बैंकों का और कुछ इलेक्ट्रिसिटी बोर्ड का भी डीएसए लेके रखा है, जहां पे ये कैश कलेक्शन करते हैं अपने अकाउंट में और वो बैंकों को या उस कंपनियों को डिपॉजिट करते हैं, उसके एवज में इनको कमीशन मिलती है. सो नाउ व्हाट द क्वेश्चन इज कि जो कमीशन है दैट इज टैक्सेबल, बट इनकम टैक्स से इनको ऐसा नोटिस आ रहा है कि आपका कैश डिपॉजिट बहुत ज्यादा हो गया है. तो ही वांट अ क्लैरिटी अबाउट दिस थिंग सर.
Sir, this is a tax planning kind of question. I can refer it separately. I don't want to tell it in a public forum. It's a planning which...
No sir, it is not a planning. You are getting it, not getting it. सर एक कमीशन एजेंट है जो कैश लेता है किसी डिपार्टमेंट के एवज में. सपोज मेरे पास में एमएसईबी का कलेक्शन है, कलेक्शन डिपार्टमेंट है.
पेमेंट हो रहा है कि नहीं है सर, उसको पेमेंट है तो दिखा दो, कोई प्रॉब्लम नहीं है सर.
हाँ,
जो भी हम डिपॉजिट
तो यू कैन गिव अ रिप्लाई.
You can give a reply. If it is genuine transaction, you can give a reply.
Yes, sir. एक और क्वेश्चन है सर, if TDS has been deducted at lower rate and same has been paid, will the expense be disallowed? Because this is unclear in the Income Tax Act 1961.
Technically, there are a lot of cases where lower deduction will be allowed, even though you have deducted lower than what is the specified tax rate. However, the assessee would be a assessee in default. So you have to pay the difference in TDS and interest. But because the law says deducted or not deducted and not remitted or not deducted is the clause. Nowhere it is mentioned that whether it has been deducted at a lower amount. So because of that, even if you have deducted, say, professional, CA, instead of deducting 10%, you deduct 2% or 1%, and you have remitted to the government before the due date. Can I allow this as expense? Yes, it is allowed by the law. A lot of case laws are there supporting it, but still, the new law is also not plugged in that particular loophole. But based on the previous judicial precedents, it can be taken.
So, एक और क्वेश्चन है, whether all the existing income tax forms ITR 1 to ITR 7 will be changed from next year?
Sir, we have to wait for the budget. We have to wait for the budget and the rules and the forms to be notified.
बहुत सारे लोगों का सर एक ये डिमांड है कि आज का जो आपका पीपीटी का सेशन था, जो पीपीटी आपने बनाया है, ये सभी लोगों को चाहिए सर.
हाँ, मैं
क्या?
देता हूँ सर. मैं डायरेक्ट टैक्स कमेटी को दिया है सर.
Yes sir, we can distribute the PPT after that. We want to share all that.
Okay.
बाकी सर रेगुलर इनकम टैक्स के क्वेश्चंस है, न्यू टैक्स रेजिम से रिलेटेड क्वेश्चंस नहीं है. जो ऑलरेडी जिनको इनकम टैक्स के मैटर्स है, इश्यूज है, उसके रिगार्डिंग क्वेश्चंस है, तो सर वो लेने चाहिए.
हाँ, यस सर.
ऑलरेडी सर लोगों को क्वेश्चंस है, इनकम टैक्स जो एक्ट अभी है उसी में कुछ क्वेरीज है, वही
हाँ,
क्वेरीज
मैं लूंगा सर, कोई प्रॉब्लम नहीं है सर. 5 मिनट.
सर एक ये क्वेश्चन है, how to offer in income tax and income if the same is not accounted as export benefits in books of accounts in case of advance authorization or similar benefits.
Sir, there is specific clauses in section 28. You can show it in tax audit report. Also, there's clause 16. You can show that particular item, amounts which are not credited in profit and loss. So that can be
Okay,
shown.
Please explain the provision for presumptive taxation that वो भी हो गया है. By the presumption which is not. Repetitive questions है सर काफी.
So evidence in tax audit is we have it in our clause 26B. I also saw one question.
Yeah. ये राजेंद्र खंडेलवाल जी का क्वेश्चन है, सेक्शन 535 सब क्लॉज 3 whether reference to subsection 1 is proper.
Huh?
Section 535 sub clause 3 whether reference to subsection 1 is proper.
535, section 535. One second. So 535, I'm just getting the clarity. I'm just taking out the section. If any difficulty arises in giving effect of provisions of this act, central government by may of general or special order do anything not inconsistent with the provisions which appears to be necessary or expedient for removing the difficulty. It is same as giving notifications or circulars, sir. 535(1). CBDT or central government can give clarifications if there is any doubt in the law. Section 535.
Okay, sir.
It's a query. I think if the query is relating to that, yeah, it can be shown.
Sir, clarify on section 44 AD and section 44 ADA.
So the clarity in 44 AD is for eligible business. 44 ADA is for professions. 44 AD, in 44 AD, what happened is 44 AD4, suppose you have shown profit lesser than 6% and it's more than basic exemption limit, the next 5 consecutive assessment years, you can't take presumptive taxation scheme, and in those years you have to do tax audit. Whereas in the new section 58, you have shown income lower than 44 AD, whatever is shown in 58, lower than 6% or 8%. Even in that particular year, you have to do tax audit, as well as the 5 consecutive years after that, you have to do tax audit. If that is the query, that is.
बहुत सारे लोगों ने सर आपकी बहुत तारीफ की है. एवरीबॉडी इज प्रेजिंग योर सेशन. सब लोगों ने बहुत तारीफ किया है सर. Thank you for such an enriching and insightful session, which we have seen after such a long time in the direct tax matter. सर हम लोग ने नागपुर में भी एक सेशन लिया था, सेशन इनकम टैक्स न्यू एक्ट के बारे में, बट उसमें और आज के बारे में आज जो हमने देखा है बहुत फर्क है सर, बहुत फर्क है. Really very appreciable, sir. आपका आज का commendable रहा, and we thank you sincerely. I also like to thank today's department representative, Sri Aniruddha, IRS officer, DCIT, Gurugram, for his special deliberation. उनकी बातों से ये तो समझ में आया कि इनकम टैक्स चाहती है कि इनकम टैक्स लॉ गवर्नमेंट चाहता है कि इनकम टैक्स लॉ इजी हो, सिंपलर हो, लोगों तक आउटरीच हो, और एक बार रीडिंग करने से लोगों को समझ में आ सके. और सर, द वे यू हैव टोल्ड टुडे, जो आज आपने जो सेशन लिया है, तो हम बिल्कुल इत्तेफाक रखते हैं कि गवर्नमेंट जो चाहती है वो एक्ट में दिख रहा है. Thank you, sir. I also like to thank Chairman of the Direct Tax Committee, CA Praful Chachad ji, and Vice Chairman of the Direct Tax Committee, CCM Vishnu Agrawal ji, for choosing me, for allowing me to moderate this session and also get enriched with the knowledge which I have gained through this session. And at last, I will like to thank all the participants who participated in this session and was also actively questioning the new things which they are founding in the new tax regime. लगातार क्वेश्चंस हम लोगों को आ रहे थे. थैंक यू, आप लोगों ने पार्टिसिपेट किया. एंड एट लास्ट, I like to thank the technical and administrative team of Direct Tax Committee of ICAI for handling this webinar in a very smooth way. Thank you all, and we'll see you all in the next session. We are signing off till the next session. See you all.
Thank you, sir. Thank you.
Good evening. Yeah.
Tech team, we can stop recording now. Yeah.